Let's be honest, for most business owners, corporate tax is a two-word headache. It feels like this giant maze of deadlines, weird acronyms, and rules that are just designed to trip you up. But you know what? It doesn't have to be that way. We're gonna break it all down, piece by piece, and turn that tax season stress into actual strategy.
You know, this quote from Michelle Fagan, it just says it all, doesn't it? That feeling of hating all things accounting, I think a lot of us can relate to that. But then there's that huge sense of relief when you finally feel comfortable and know what you're doing. That feeling is exactly where we're headed today.
So yeah, if any of that sounds familiar, you're in the right place. We're going to take that headache and turn it right into confidence. We'll walk through the absolute must-knows of Canadian corporate tax, and we're going to start with the most important question of all. Okay, let's start at square one. It seems like a simple question, right? Who actually has to file a corporate tax return in Canada? But trust me, the answer surprises a lot of people, and getting this one wrong can cause some real problems down the road. So here's the official rule, straight from the Canada Revenue Agency, the CRA. It says that all resident corporations have to file a T2 return every single year. Now, the keywords there are all resident corporations. And as you're about to see, that word all means exactly what it says. This is the part that trips everybody up. This rule applies even if your corporation made zero money, or heck, even if it lost money. We're talking nonprofits, tax-exempt corporations, and get this, even corporations that are completely inactive or dormant. So the bottom line is pretty simple. If you went through the trouble of setting up a corporation, the government expects to hear from you every year, no exceptions. All right, so you know you have to file. What's next? What's next? Well, the deadlines. And this is where it gets a little tricky, because it's not just one date you have to worry about. It's more like a race against two different clocks, and they're both ticking. And here it is, the crucial difference. You've got one deadline for paying any taxes you owe, and a completely different deadline for filing the paperwork. The money, the taxes owed, has to be paid within 3 months of your fiscal year end, but the actual return, the T2 form, isn't due until a full 6 months after your year end. Let's see how that plays out. So let's just imagine your company's year ends on December 31st. As soon as that clock strikes midnight, your payment clock starts ticking. Your tax payment is due by March 31st. But you still have another 3 months after that, all the way until June 30th, to actually get the paperwork, the T2 return, filed. You can see how easy it is to mix these two up. And this is why it matters so much. If you wait until your filing deadline in June to figure out what you owe, guess what? You're already 3 months late on your payment. And the CRA charges interest and penalties on those late payments, and they add up really fast. So just remember this, pay first, file later. Okay, so you know you've got to file, and you know the deadlines. But here's the thing. You can't just print out your QuickBooks report and mail it to the CRA. Nope. You have to translate your financial statements into a special language that the government understands. And that system, it's called GIFI. So what on earth is GIFI? Well, GIFI stands for the General Index of Financial Information. The easiest way to think about it is like a universal translator for your business's numbers. It's just a standard coding system that makes sure everyone's financial information is presented in the exact same way so the CRA can process it all efficiently. The process itself is actually pretty straightforward. You start with your normal financial statements, your income statement and your balance sheet. Then every single line item on there, from your total sales down to what you spent on coffee for the office, it gets its own unique GIFI code. That final coded document is what you actually submit with your T2 return. So far, we've really just been talking about compliance, all the stuff you have to do to stay out of trouble. But the real magic, the real power, comes when you move beyond just filing your taxes and you get into smart, proactive tax planning. This is where you can make a huge difference to your company's bottom line. So what does that actually look like in the real world? Well, it means planning your income so you can stay under certain thresholds, like the small business deduction limit, which gets you a way lower tax rate. It means knowing that if you have a business loss this year, you might be able to use it to get a refund on taxes you paid in past years. The goal is simple. You want to legally and ethically build a structure that ensures you pay the absolute least amount of tax possible. Okay, we have covered a lot of ground. So let's just boil it all down. If you walk away from this explainer remembering nothing else, I want you to lock in these 3 key things. First, and this is the big one, everyone files. If you have a corporation in Canada, just assume you have to file a T2 return. It doesn't matter if you're profitable, losing money, or totally dormant for the year. You file. Number 2, burn those 2 separate deadlines into your brain. You've got 3 months from your year-end to pay your taxes, and you've got 6 months to file the paperwork. Getting those 2 mixed up is a really costly mistake. And finally, number 3, remember that just being compliant, just filing on time, that's only the starting line. The real advantage, the real power, comes from proactive planning.
Thinking ahead about your taxes isn't about avoidance, it's about optimization, and that's just plain smart business.
So there you have it. You know the basic rules of the game. But these fundamentals aren't just a list of chores. They're the actual building blocks for a much smarter financial strategy for your business. So the only question left is, how are you going to make them work for you?